What if I told you that chasing the worst performing stocks could actually make you richer than following the winners? Sounds backwards, right? But stick with me, because today we're diving into why buying the biggest stock market losers can sometimes be the smartest move an investor can make. Here's what you'll learn. We'll break down this surprising strategy, look at what history says about it, and figure out when and why betting on the underdogs can seriously pay off. So, let's get right to it. Most of us are taught to follow the winners. Buy the hot stock, chase momentum, stick with what's working. But here's where it gets crazy. Over and over again, research shows that some of the best returns actually come from buying the stocks everyone else has given up on. That's right, the companies that have just had a terrible year, the ones nobody wants to touch. Why does this happen? A lot of it comes down to something called mean reversion. Basically, things in the market tend to swing too far in one direction and then snap back the other way. So when a stock gets crushed, let's say it drops 30%, 40%, or even more in a year, investors often panic and dump it. But if the company's still fundamentally sound, that stock might be oversold. And when the panic fades, the price can rebound big time. But here's the twist. This isn't just a theory. There's actually decades of data behind it. For example, studies have looked at the performance of the biggest losers in the S&P 500, the bottom 10% each year. Over time, these loser stocks have tended to outperform the previous year's winners. That's wild, right? And it's not just the US. Similar patterns show up in markets all over the world. Now, you might be thinking, wait, isn't this risky? Aren't these companies in trouble for a reason? And that's a fair point. Not every loser stock bounces back. Some do go bankrupt. But here's what no one tells you about risk. The market often overreacts to bad news. If you spread your bets, instead of picking just one or two fallen stars, you buy a basket of them. The odds start working in your favor. It's all about probabilities, not guarantees. Let's put it in perspective. If you'd bought the most hated stocks in a given year, you might have faced some serious stomach-churning moments. But historically, over the long run, this contrarian approach has delivered above-average returns. Why? Because you're buying when everyone else is selling, and selling when everyone else is getting greedy. That's classic Warren Buffett advice. Be fearful when others are greedy, and greedy when others are fearful. But here's something else to consider. This strategy isn't for everyone. It takes guts to buy what everyone else is avoiding, and you need patience. Sometimes these stocks take months or even years to recover. And of course, you've got to do your homework. Not every beaten down stock is a hidden gem. Some are just, well, duds. So what could this mean for the future? As markets get more volatile and headlines get scarier, opportunities for contrarian investors might only increase. If you can keep your cool and look past the fear, you might just find some bargains hiding in plain sight. If you found this breakdown helpful, make sure to hit like, drop your thoughts in the comments, and subscribe for more insights like this. Remember, sometimes the best investment opportunities are hiding in the places no one wants to look. Will you dare to be a contrarian next time the market panics?